Welcome to this explainer on Varun Beverages. Today, we're unpacking a really fascinating corporate chess match playing out right now in August of 2026. We are looking at a massive company executing a seriously high-stakes two-front strategy. On one hand, they are fiercely defending their home turf in India against some aggressive new market disruption. And on the other, well, they're launching a massive, multi-category offensive across the African continent. It is a classic tale of balancing defense and offense, and we're going to break down exactly how they're pulling it off.
So let's kick things off by asking a pretty critical question. How exactly does a beverage giant, one that's been comfortably bottling Pepsi for decades, handle a sudden, highly funded disruption in its primary market? Because right now, the Indian beverage landscape is getting a massive shakeup.
The current battlefield is super polarized. Coca-Cola is leading the pack with an estimated 41% market share. But look closely at that 8% slice. That's Campa Cola. Backed by the immense deep pockets of Reliance Consumer Products, Campa has just aggressively snatched up a huge chunk of the market through value pricing and offering massive distributor margins. This leaves Varun Beverages bottling Pepsi at around 29%, caught right in the crosshairs. They're feeling the heat from Campa's expansion, not to mention a potential billion-dollar Indian IPO looming from Coca-Cola.
Section 1. The Indian Beverage Battlefield. Playing Defense. VBL's reaction here is a brilliant display of operational defense. Instead of panicking and building massive brand new greenfield plants from scratch, which, by the way, they already poured 1,700 crore rupees into last year, they are leveraging what they already have. They're selectively rolling out 10 rupee entry price points in rural areas. And even more importantly, they upsized their 20 rupee packs from 250 to 400 milliliters. Now sure, that slightly reduces their per case profit, but it drives massive volume. Combine that with deploying up to 1 million new Visicoolers, and you've got a strategy completely focused on raw retail dominance.
Moving to Section 2, Q2 2026 Financial Performance. Armor holding up. Now you might be wondering, is this defensive strategy actually working against such well-funded rivals? Looking at the financials for the first half of 2026, the short answer is an absolute yes. Their brand and operational execution have formed a really robust anchor, yielding surprisingly strong financial armor.
Okay, so check this out. Despite a highly inflationary environment for raw materials, VBL achieved a 20.4% jump in revenue, crossing 84 billion rupees for the quarter. EBITDA was up 17.2%, and their profit after tax jumped 15.1% to over 15 billion rupees. They even managed to improve gross margins to 55%, basically by smartly stocking raw materials early and selling a higher mix of low-sugar products. So they are defending their turf, and they're doing it profitably.
But here's where the story gets really fascinating. While the domestic Indian business held its own with a very solid 14.4% volume growth, their international growth completely blew it out of the water, surging by a massive 38.4%. And that incredible international momentum leads us directly into their next massive strategic maneuver.
Section 3. Strategic Expansion in Africa. Playing Offense.
This dual-horizon strategy is a total masterclass in resource allocation. In India, like we talked about, they're optimizing existing operations, pushing value packs, and fighting for cooler space. But in Africa, they are on a full-scale offensive. We're talking major mergers, building brand new facilities from the ground up, and bravely entering entirely new product categories that go way, way beyond just bottling Pepsi.
Just look at these swift, decisive moves across the continent. They acquired South Africa's Twiza, which is a leading soft drink manufacturer, for over 2 billion rand, immediately bypassing the need to build from scratch. They bought Crickley Dairy for 238 million rand to establish a dairy platform. They're pushing snacks in Morocco and Zimbabwe, and perhaps most incredibly, they're moving beyond soft drinks entirely to beer. Yep, they are preparing to commission a massive greenfield Carlsberg brewery by 2027 to tap into Africa's booming alcohol market. Africa is basically their growth engine right now, and they are scaling up fast.
Section 4. Partnerships and new products. Securing the future.
VBL is playing a really long game here. They just revised their exclusive agreement with PepsiCo, extending it all the way out to 2049. And crucially, they got a restriction removed that previously forced them to operate solely for PepsiCo, which unlocks incredible operational freedom. They also dropped $32 million to acquire Devyani Food Industries in Kenya, instantly gaining an established distribution network for their energy and soft drinks. Plus, leveraging that new flexibility, they formed a franchise alliance with Japan's Asahi to bring the iconic 100-year-old Kalpis dairy brand into India.
And finally, Section 5, Stock Valuation and Fundamentals.
So all that consistent operating cash flow is translating directly into consistent shareholder returns. They have been steadily paying out dividends, most recently approving an interim dividend of 0.50 rupees per share in July 2026, marking a cash outflow of nearly 1.7 billion rupees.
As of early August 2026, VBL stock is trading right around 442 rupees. This gives the company a massive market capitalization of nearly 1.5 trillion rupees, and it trades at a price-to-earnings, or PE ratio, of 43.69.
But when you actually run the intrinsic value models, looking at enterprise value to EBITDA and price-to-sales ratios, the data presents a stark reality. The estimated median fair value sits around 385 rupees. This means the stock is currently trading at roughly a 15% premium to its fundamental fair value. So, the objective picture here is pretty clear. VBL boasts incredibly strong fundamentals and an undeniable upward earnings trend. However, investors are definitely paying a premium for that growth narrative. It's also worth noting they carry a consolidated debt-to-equity ratio of 0.33, which is a hefty anchor, largely fueled by that aggressive African expansion we talked about.
Ultimately, VBL is a company boldly fighting on two distinct fronts, leveraging their Indian fortress to fund a vast African empire. So we'll leave you with this final thought to consider. Will this bold, multi-category African offensive generate enough explosive growth to justify the stock's premium valuation? Or could the intense, margin-squeezing cola wars back home ultimately disrupt their momentum? It's a fascinating corporate balancing act, and one the entire market is watching closely. Thanks so much for joining us for this explainer.